Welcome to our channel specialized in investments in stocks, as well as cryptos and other investments. My name is Monica and I am your host. Disclaimer, we don't do any financial advice. We are a group of international experts from the asset management industry. We used to work together. Some of us are just retired like my father and others are still working. We would like to teach you some finance concepts as well as building investment portfolios to make money. We use avatars for privacy reasons, but we have each our proper investment style and behavior. Sanjay and I are specialized in cryptos. Eduard is keen on asset allocation and stocks. Nicholas is a specialist on alternative assets, for instances. Each video will start with an analysis of financial markets and recent events. Then we will go to our two portfolios and build their positions. And then we will finish with ideas or themes. These ideas and themes are often critical concepts in asset management that very few people really know, even in our industry. Please stay until the end of the video. It should help you to understand better how financial markets behave, and it will benefit to your portfolio. Last point in our videos, we will sometimes illustrate with our friends the Buddha animals. Each of them has a proper investment style and behavior. We will start with 4 of them. The dragon, generally bullish and confident. The monkey, who is malicious and smart. The tiger, who generally likes calculated bets. And finally, the rabbit, wise and prudent. Chapter 1. Financial markets. Today we start with the global context in financial markets as we foresee it for the next 2 years. There is a critical risk for developed markets to be in stagflation, meaning low growth with high inflation. US equity market is still very dominant in asset allocation, representing 70% of the index MSCI World, the most important weight of the United States in global equity indexes ever. We don't predict the end of the US, but we are careful about their dominance, especially compared to emerging markets, who seem to have a lot of advantages: cheap valuation, stronger earnings, decorrelation, and benefiting from a lower USD. What to do? Going outside of the US and developed equity markets to seek growth in emerging markets equities.
Chapter 2. Portfolios. Hello everyone, my name is Edwards, and I will have the pleasure to present our strategy on portfolio management. Now we start our 2 portfolios. Their spirit fit both with the tiger and the rabbit. The tiger for its calculated bets, and the rabbit for its prudence. First portfolio is in stocks and ETF, mainly in emerging markets, available on a lot of financial platforms. For practical reasons, we have chosen to work with Revolut that provide global services. You will find details of our trades in the description. Remember the context: we fear that global markets are a bit stretched, so we invest only 70% in risky assets and keep 30% cash, 70% tiger and 30% rabbit. It could change in the future, but today we are prudent. Second portfolio is invested in cryptos, with the same allocation 70-30 due to the context. The 2 portfolios are investing regularly each month, 50 USD or 50 euros or whatever you want depending on your geography and financial resources. Investment horizon is 10 years when our children and grandchildren will need a capital to start their life. Portfolio 1 starts with 70% in ETF EM and 30% cash. Portfolio 2 starts with 2 cryptos, BTC and ETH. This is the first investment, so not too much timing. But next week we will start using our skills in technical analysis.
Chapter 3. Ideas and themes. Hello everyone. Today we explore an indicator very important for our global strategy, the growth inflation quadrant analysis. It shows where we are in the economic cycle and what are the good investments in each part of the quadrant. This strategy fits perfectly well with the monkey. You draw a simple graph with 2 indicatives, economic growth and inflation. We use 2 axes, vertical axis, economic growth, low, high, horizontal axis, inflation, low, high. This creates 4 situations, quadrants. 1, low growth plus low inflation, situation of sluggish growth, disinflation. Weak demand, slow economy, higher unemployment risk, low investment. Example, Europe in the early 2010s after the financial crisis. Central banks may stimulate with low interest rates. 2, high growth plus low inflation, the ideal situation, often called a Goldilocks economy, not too hot, not too cold. Solid growth, low unemployment without inflationary pressures. Corporate profits rise, equity markets are strong. Example, United States in the late 1990s before the dot-com bubble burst. 3. Low growth plus high inflation, situation of stagflation. Very unfavorable, weak growth but rapidly rising prices. Purchasing power falls, companies struggle, policymakers are trapped, raising rates worsens recession, cutting them fuels inflation. Example, 1970s after the oil shocks. 4. High growth plus high inflation, situation of economic overheating. Strong demand, high employment, but prices rise quickly. Central banks react by tightening monetary policy. Example, United States in the early 2020s after COVID, strong rebound plus high inflation. Summary, best case, high growth plus low inflation. Worst case, low growth plus high inflation, stagflation. The other two quadrants are transitional phases, key for anticipating monetary policy and market cycles. Conclusion, it depends also where you are investing. Quadrant is not the same in US, Europe and India. As we are investing in emerging markets, we benefit from a positive quadrant in growth with moderate inflation. The dragon has chosen a long-term strategy in emerging markets. The tiger and the rabbit have created portfolios with a combination 70% risk, 30% cash. And finally, the monkey has taught you the growth inflation quadrant. I let you think about it. Please make some comments or ask questions. We will see how to use the quadrant and other important applications in our next video. And don't forget to subscribe to our channel. You won't regret it. Bye bye.